Hello, Jim here. I've been trading options for a number of years and I've been able to make some really good income on a monthly basis. On occasion, though, I want to make a trade where I don't really care to own the shares. Today, I'm going to talk about that trade, how I like to actually trade IWM with a vertical put credit spread or an iron condor. And I'll do this pretty regularly and make some pretty good income. I'm going to share with you the strategy in a little bit more detail and the actual setup, as well as the most recent trade I made with it. So stay tuned. I think it's going to be well worth your while. Okay, now my go-to trade is to sell vertical put credit spreads, and in some cases also iron condors on IWM. And you might ask, why IWM? It's the actual Russell 2000 ETF. It kind of tracks the Russell 2000, and it's currently priced right around 210. A lot of people will do similar trades, but they'll do it with SPY, or QQQ, which are both very expensive. I believe they're in the $500 to $600 range. Since I don't trade them that often, I sometimes forget how much they cost. I like IWM because it's right around that 200, 210 range. And when I write or set up a vertical put credit spread, I can usually do it at like a 10% discount. I like to do it around a 15 delta, and I try to earn pretty close to $100 per contract. So I'll do two contracts, earn around $200. And I've been doing it going back 3, possibly 4 years, dozens of times. I've never been assigned. I think I've only had to manage it a few times. So it just works out really well. When you find a trade that tends to work well, you want to make modifications to potentially improve it, but you want to kind of stick with it. I probably do it fairly often, maybe once a month. Um, and again, it's fairly simple to set up. I'll show an explicit detail at the, or not detail, but an example at the very end of the video while I'll go through the setup for it and what it typically looks like. I do it pretty risk averse. It's a really safe trade. Um, and the times that I'll do just the vertical put credit spread is during times like now where we've got the tariffs, we've got this tax bill that's hanging over us, and now we have the war in the Middle East between Israel and Iran. So I don't feel comfortable doing iron condors if the economy and the market and everything was kind of treading sideways. I might do iron condors. At this time, I prefer to do vertical put credit spreads during times of high volatility and potential big risk. Again, I prefer to do the vertical put credit spreads. I'll do them again at a 15 delta. I'll go out anywhere from 40 to 60 days, sometimes even a little farther. And this is so I can get a really low strike price for the short. And again, it ends up being right around 10%, like a 10% discount. So currently IWM is 210, and the latest one I did, the short was 190. I did a 190, 180. And I also like to do that kind of a spread. I'll start with a $10 spread. So in this example, again, a 190, 180. And then what I'll do is I'll try like the 181 or the 182 and look at the next few thinner spreads to see if maybe they're more profitable. You'd be surprised, on probably 30% of my trades, they are actually a little bit less expensive. I do get members that ask me, well, why are you doing a 7, 8, $9 spread? Why don't you just stick to $10 spreads? But if you can do it, make the same amount of money for a smaller spread, then your return on equity or return on investment is going to be that much better. And again, it turns out to be about a 10% discount to the current price. So, and I don't necessarily see that with a lot of other positions. Now, I will go with a shorter DTE or a smaller DTE. If I can, I'll go out 30, 40 days. Currently, I'm doing August 15th. I prefer to trade on monthly expirations, which is, again, August 15th. I believe it's July 18th or 19th. And I did look at July, and I could still do a trade at that point, but I think it was $50 or $60. So in some cases, it might make sense. Now, if you can't do spreads, you could also do this as a cash secured put. It does require a lot more capital in that instance. Um, but again, what's important to me is when I'm looking for a trade and I don't really care to own the shares, this trade works out really well. Um, then I typically will manage at 21 days. I'll look at it sooner if the market moves quite a bit. If the market goes up, then that vertical put credit spread can become very profitable quickly. The previous one I did, which I believe I did in the April timeframe, I was able to close it early, so I didn't even have to keep it. Uh, I believe it was about 10 days early. So instead of being like a 50 DTE, it was ended up being like a 40 DTE. And that happens fairly often too. I've had other times where I just let it expire, it just stays outside the money. And I have had to manage it maybe 10, 20% of the time. Probably not even that much. Like I said before, I had a position actually open when the market dove in April, and when it recovered in early May, I was able to close it, and that one worked out really well. So managing it 21 days just seems to work really well. I typically will try to close at 75 to 80% profit. So if I bring in 200, if I can close it for like $30 or less, then I'll consider it. A lot of times I tell people if it's like going out to lunch for you and your wife, then it's probably okay to close it. If it's like dinner for you and your wife, well, then it's still fairly expensive and it may not be the right time to close it. But if you are able to close it earlier, I've also found that if you can close a position early and then later open a new one, so it's kind of like a delayed roll. So you close it now, and maybe 2 or 3 weeks later, you open another one, or maybe only a week because of what happens in the market. Those kind of trades can be a lot more profitable versus a roll that's all in one, meaning you roll it in one trade. At least that's what I found when I compare those kinds of trades. So I think examples are the best way to learn this stuff. So let's jump into the next part where I'll show you a little bit about IWM. I'll share with you the last trade I did and what a setup looks like. So stay tuned. Let's jump into the next section. Okay, now I'm in bar charts. This is the Bollinger Band. It's set up for 5 year, and then it's got the 20-day moving average. And you can see right here, its price is pretty close to the 20-day moving average. If you did a trade at around 190, you're right around here. So you're closer to the bottom band, which is what I like to see. This is primarily how I use the Bollinger Band. I like to see if I'm closer to that lower band. Um, Not necessarily to decide to make a trade or not make a trade, but it can help me make that trade, or give me a little bit more confidence that it's not overpriced, or it might be trending in the direction I don't want it to trend in. I also will look at RSI, and RSI is okay. It's around 50, 49. So it's not necessarily oversold or overbought, somewhere in the middle. And you can see it's currently 209. The other reason I like it is if you look at option prices, it's got tons of activity, a lot like SPY, or QQQ. If I go out to the monthlies, like we'll go out to 815. Here we go. This is monthlies, and you can see it's 58 days. So right between that 40 and 60-day range. And again, you can see these are calls. You come down to puts, and you can see it's got lots of activity, lots of open interest, a good amount of volume. I like to do around a 15 delta, so I have to come back up. I need to change this to 20 strikes. Let's see if we see it now. So we'll come down to puts in a 15 delta. There's a 16 delta right at 190. I can actually widen this a little bit more and go to 50 strikes. And if I come back down, and I know that the 190 was really close to the 15 delta. So here's the 15 delta. So it's 189. So I would look at both of these when I did the trade. I believe I did it yesterday. I went with the 190. So I took a little bit more risk. I did closer. I think yesterday it was closer to a 15 delta. And then I will go $10 out. So 190, then I'll look at 180. So 118 to about 120 is what I would pay. And what I would earn would be between 206 and 209, which is really close to that $100 per contract. So you subtract the 120 minus the 209, and you're right there at like 90 cents for one contract, or $90 if you multiply by 100. And the fact that you have so many contracts, that's good. So, overall, I like what I'm saying. And you might ask, well, why do you not really care to own it? There's other positions I would rather own than IWM. If you compare IWM to SPY or the S&P 500, it's done a lot better than the Russell 2000. Now that could change if the environment gets better for small companies, meaning the Fed makes some more rate cuts, and a lot of these regulations that impact small business get removed or eliminated, then the Russell 2000 could come back majorly or in a major way. But over the last 10, 15 years, SPY has done better. And QQQ, I believe, has even done better than SPY. So that's the main reason. And like I said earlier, I really wanted to find a trade that I could repeatedly make or consistently make. And this has been it. I probably have done 2 to 3 dozen of these, and none of them have been assigned to me. And like I said before, only a few have I had to actually manage. Most of them I either closed or they expired outside the money. So let me next show you the most recent trade I made, and then we'll jump into what the setup looks like. So stay tuned. Okay, now I've opened up Patreon and brought up my IWM trade that I did actually 2 days ago. This would have been on Tuesday. I did exactly what I showed earlier, a 190, 180, expiring on 8/15/25. I believe on Tuesday it was exactly a 60 DTE. It was a 15 delta, 0.1580, so a little bit on the high side for a 15 delta. Premium collected 185. I prefer to get closer to 200, but for these trades, I'm okay to take, 180, 190. Most of my trades, especially vertical book credit spreads, are usually over 200. They're 210, 220, 240, something like that. This was a 63% return. That's for yearly. So if you take the income or the premium that's brought in divided by 2,000, or the spread minus the premium you brought in, and then adjust for the year, that's how I come up with that 63%. I use that more for comparing spreads against other spreads. I don't necessarily, because a lot of times I'll close these early. Sometimes they will expire, but then other times I might roll it early, especially if it does get into trouble. And then I usually do a bit of a description. So I talk about the security, why I like it, here I'm saying it's my go-to trade. If it's a stock, I'll talk about, fundamentals. How does it look profitability wise? How does it look debt to equity? Is it growing? How does, long-term growth look like? And then how does cash flow look like? If it's paying dividends, is it growing those dividends? So I'll talk about a lot of that here. I also will share a section where I mention, you could do this as a cash secured put if that's what, the way you'd rather go. I also encourage people or members to potentially modify their trade. They may find a better way. Maybe they go with a different DTE, maybe slightly different strikes. They might be willing to take a little bit more risk. So I encourage people not to just take the trade, but dig into it. Be sure they want the trade, and then how could they modify the trade that might fit better in their plans or their portfolio. And then I will share a screenshot of typically the activity page for Fidelity or the history page for Schwab. Um, And I do this, I typically post it right after I make the trade. On occasion, I'll put trades out there, I'll leave them open and I don't realize they're filled to the next day. So those are the exceptions. Sometimes I won't post those till the next day. And then I sort them. I put them into specific collections. Like this one has been put into the vertical put credit spread collection. I also have collections related to wheel strategy, small accounts. So there's quite a bit here. And I also copy it to Discord. I have a section within my Discord where I put all my trades. And then I have sections where other members will add their trades if it's a very risky trade, and I will police the community just to be sure that people are posting in the right places. Meaning, if you're doing a very risky trade, I want you to put it over into the risky trade channel. I'll also ask people to show screenshots of their, of the information from the broker. Meaning, if they've had a very successful trade, we also have a section for winning trades. And it's questionable, just what I'm seeing doesn't necessarily make sense. I will ask them to provide some information like a screenshot related to the confirmation within the broker. So that way everyone's on the up and up. I do have some members, and I'll be frank about this, that take more risk than me and do get better returns than I do. And I'm okay with that. I'm going to be turning 60 in a couple months. I don't have the benefit of many years or taking too much risk. I'm happy with my returns. And I'm more of an investor than a trader. There's other people that are firm traders. They don't really care about owning the stock. They just want to make the trade. So, and I encourage you, if you want to learn more about my Discord or my membership, details will be in the description. I'm also an affiliate with Barcharts and Seeking Alpha. Links are down there. I know with Seeking Alpha, you'll get a discount if you go through my affiliate program. I will get a bit of a kickback if you do go through either of those links, but take a look. It may be worth your while. Next, let's jump into the setup and what it looks like within a trading page. We'll do it in Schwab just because I prefer, it's easier to explain when it's in Schwab. It's visually a lot easier to deal with. So let's jump into that next. Okay, here's the all-in-one trading page on Schwab. I went ahead and filled out some information. Within Schwab, you have the area for the symbol, then you have all the different strategies you might want to try. It's got like iron condor, strangle, straddles, vertical put, vertical call, so they make it really easy. It'll populate the page. And it just is easy to deal with. They've even added some more bells and whistles, a little bit more detail about the 52-week range, the day range, different bid and ask sizes, the current price at close. At first, they didn't show quite as much. And then also like this, you can see the full quote. So they have all the Greeks here. They've got how many days to expiration, the underlying type, quite a bit of detail, the open and close, last, and then the Greeks, what I really like seeing the Greeks here. So you can see right now it's a 17 delta. And then just to close it, we can close it here. So that's pretty close to what I would try to. I like 15 delta, but sometimes I'll do 16, 17 delta. At times there might not be a 15 delta. So let's go a little lower. Let's go to 195 and see what delta exists. So 15 delta exactly. And then again, I'll come down here. The first leg is the sell or the short. So I'm selling to open, then I'm buying to open. And this is for protection on the downside. It also means, since I could put these shares to someone else at this price, I don't need as much cash or margin. There's a lot of talk about different types of margin. There's true margin where you are charged interest, but there's also this type of margin where you can use spreads and you get credit for the put. Now, if you need, I believe, option level 2, I think it's option level 2. So within Schwab, there's 0 that I think most people get, then 1 and 2. For 2, you can do spreads. Now, if I, well, let's put this at 185. So we can see it's about 84 and 195, 185. A minute ago, we were looking at 190, 180, and it was just a little bit more premium. So there is an argument. This is only 30 days. Let's look back and see again. It's 29 days. So it might make more sense to do this trade because this is 81. I typically will do 2, which is 168. So, and again, the market's changed since I made this trade on Tuesday. But there'd be an argument, well, let's just go out 30 days and let's bring in 168, but it's for 30 days. I could potentially do another trade. Then at the end of the 30 days, I make another 168. Now, some people will take more risks, so they might say, well, I'm willing to do a 20 delta, so we could look here at 200 potentially. And then we would, if you're going to do a trade like me, I like the $10 spread. So they could say, well, I'll do 200. That's a 23 delta. And I want to pick up that extra income, which, and I, right now the numbers, it's still using the 84 from the previous one. But if I click on this, it'll update it to 128. Now, when I make a trade, I like to do it pretty close to the ask. So the ask is currently at 132. So I would probably, there's enough activity with IWM, I might do the full blown ask. So for this trade, taking a bit more risk, 200 to 190, I would bring in 264 versus 160. Now that's pretty close. Could it get to 200? It could very well get to 200. So you might end up having to manage this trade a lot more, taking a bit higher risk. Since this is the trade where I don't really care to own the shares, I like to go with less risk. So if I go out to 7 or 815, and you can see they both changed at the same time. Now 200, the delta typically will go up. So it's a 27 delta. That's pretty risky in my book because that's saying from now to 815, if IWM goes below 200, there's a good chance they're going to be assigned to me. Well, 100% chance if they go under 200. So I will look for a 15 delta. I already know 190 is right at a 15 delta. Let's put this as 180. We look over here, the delta is 0.1586. So 190, and then I go out 10, and it's right around 180. So there is an argument, take a little bit more risk, go with a slightly higher delta and only go out 30 days. And that's the kind of thing I want my members to look at and decide what they want to do. Now, if you have a really large account and you'd be fine with owning IWM, you might go with higher risk. And then you can change other things too. You might want to do more contracts. So say you did 4 contracts. I'll do 4 on both of these. And I don't know why that got weird. Why I did 560. Oh, it's because I got to click on this again. So it would be more like 360. I prefer to keep these at 2. I have done 3 on occasion. And again, we're getting some weird numbers here. Like I said, I've done 3 a few times, and even when I've done 3, they've not been assigned. Now, some people might say, well, why not do an iron condor? So if you wanted to do an iron condor, you could come over here, pick iron condor, and again, it'll fill it out. If I'm still going out to 815, I might want to go with a little bit less risk. It's what I typically tell people. So sell the open 188, and then we could do 178. And then on the call side, if you do an iron condor, I prefer to take a lot less risk. Mainly because if I don't own the shares and it does get assigned away from me, then they loan me the shares. It becomes a lot more complicated. So I always tell people to take a little bit less risk on this side. So let's see, I'm assuming it would be probably 230 maybe, and then 240. And let's see what the delta is here. 230 is a 15 delta, so I'd probably go even higher. We still got some pretty good premium, so I might say let's do a 235. Let's see what the delta is. It's a 10 delta. Um, I'm still bringing in pretty close to 70 cents, so it's either 235 or 230. And this is where, as a member, you could say, well, I'm okay with the taking the risk on the high side or the call wing. So you might decide 230. Me personally, I would probably take more or less risk and I would do the 235. And then over here, I would do the 245. So in this case, for these two wings, I'm bringing in more like 124. Now, if I did three of these, I'm bringing in almost like 372 going out to 815. Now, another thing you could do is you could go 230 on this side and say, well, I'll go 240. So you're taking less risk on the call because you're doing well, actually, this should be 235. So you're taking less risk on the call side because you're buying that long call only $5 out. So you have a $5 spread on the call wing and a $10 spread on the put wing. And you're bringing in very similar to what you had before. And you're dealing with about a 15 delta. So the big question is, do you think that it could get to 230? It got to 244 earlier this year, so it could definitely get to 230. So that's why at this time, with this crazy market, with the war in the Middle East going on, and this bill may not make it through Congress, I think they will make a deal, but I'd rather it be two or three small bills, not a gigantic bill. I really like how Ron Paul puts it. He really describes it where he'd prefer them to, um, do three or four small bills. But we'll see. We'll see what happens. So at this time, I preferred to just do a vertical put credit spread. So versus an iron condor. Once the bill has gone through, maybe the war has calmed down. Hopefully, both wars, and then the bill has made it through Congress and the president has signed off on it, and the tax cuts will be permanent going forward. Then I might look at iron condors with the environment really slowing down. But I just wanted to show you this and what it would typically look like. So I would go back to this, and then I would again go back to 190 and 180. And this is where I would say, well, what does a $9 spread look like? So I go to 181. So you see it's 86, 90, and 93. This is 79, 83, and 86. So for a $9 spread, so I'm putting 900 at risk to make around 83 or 84. So I could try 82. And again, it dropped a fair amount. So it's in some cases, with some stocks, you'll see major differences. I found cases where a $7 spread is more profitable than a $10 spread. You actually make more premium and you're using a much thinner spread. So I tell people to always take a look. I might even look to see what 183 looks like. Oops, 182, 183. Still, it's dropping 65 to 71. And then maybe look at 185, a $5 spread. So it dropped pretty significantly. I believe with IWM and ETFs, you don't see that discrepancy. It's more with some of these stocks, especially momentum stocks or stocks that have really good premium and volume. And so I always tell people to take a look at, you may find a way to improve your trade. And this is where you take a little bit more time. And then before you click review order, you just be sure everything looks good. That you've got the right number of contracts you're doing, buy to open to sell to open. So I'm selling a 190, buying a 180. I'm getting a credit I would probably go closer to 54 if I was to make this trade as is. So these are the kind of things I look at. And a lot of times I will do high on the ask side. And I've been surprised recently. A good number of times they do get assigned quickly. If they don't, then you can replace your trade. I believe that's what Fidelity calls it, replacing it. And I think in Schwab, it's just changing it. You can go to the order status page in either brokerage and you can either replace or change the trade. And all you can really change is what you're trying to make. So then I would lower it a little bit, usually by $1 and 2. So if it didn't go through at 54, I might try 53, then 52, but usually it's a little bit more substantial than that. So that's what I wanted to share with you guys. What do you think? Do you trade IWM? Is there another ETF or stock that you do this with that works out even better than IWM? I'd be curious to hear about it. So as always, thank you for taking the time to watch, and hope you have a wonderful rest of your day.